Yeah, we can.
Ooh, that's fun. Okay, because I really just wanted a pointer at this point. Okay, so this, we'll start up here with this chart, the US dollar to the Chinese yuan. And you can see 2015, and it really goes up through today. And this is showing you the exchange rate for the dollar. So if you took one single dollar and you wanted to trade it for Chinese yuan, currently you would get 7.1 yuan for a dollar. And what that means, and down here, therefore, 1 yuan is literally a dollar divided by 7.1, or in other words, 14 cents. So it's reciprocal. Does that make sense, right? So if you're trading a dollar for 7.1 yuan, then 1 Chinese unit of currency is equal to 14 cents. Okay. So there's a reciprocal thing, and that's really important because when the values change, so when a dollar changes and it's not any longer 7.1, but say it's 7.2, then this 14 cents has to go down. So the two numbers are moving in opposite directions all the time, and so that's really important. Okay, so what does this mean? Why do we care about it? Well, certainly if you're traveling to China, then you need to trade dollars for yuan so you can spend them when you get there. So you might trade, not $1 obviously, but maybe $100, and then you would get 710 yuan. Okay, and so I have an example down here below the table. It says, so a computer, and we're going to think about this not in terms of traveling necessarily, but just think about it in terms of buying things internationally. Although you could think about it traveling wise. So the first little hypothetical right here is regarding, this would be like a Chinese person coming to America, or they don't have to be here. They could be in China, but they're buying something that's made here. So a computer that's manufactured here in the US, if it sells here for $1,000, then a Chinese consumer who's buying it, because they don't think in dollars, just like you don't think in yuan, you think in dollars. They think in yuan. So when they're going to buy that computer that we sell for $1,000, in their head, it costs 7,100 yuan, because they're thinking about this exchange rate. I mean, they're not thinking about the rate, but that rate affects the way they think about it. Make sense? And then I'm assuming here that there's no other costs, like whatever you buy it for here is what you'd buy it for there, that there's no shipping or tariffs that would add on to that, of course. Meanwhile, or thinking about it in kind of from the other point of view, if there's a pair of shoes that's made in China, and if these shoes sell in China for 1,000 yuan, then from the American point of view, we're going to have to spend $140 to get that pair of shoes. So those shoes cost 140 bucks. That's what we would say, but the Chinese would say those shoes cost 1,000 yuan. And so, do the shoes cost more for the Chinese because 1,000 is bigger than 140? No, it doesn't. We can't say that is true, because there's an exchange rate between these two currencies. Okay, but why this matters is because, as you can see by this table up here, the exchange rate is not stable. It changes. It fluctuates quite a bit. And in fact, if you look at the exchange rate this is a 5-year span right here, a dollar was worth 6.2 yuan 5 years ago. It rose almost to 7, and then it dropped back to 6.3, and now it's at 7.1. Those are pretty big swings, and that's going to change what the price of those shoes appears to be from the American point of view. So then we move over here, and let's just kind of see this in practice. So there's a couple of terms that we use when we talk about currency. We use the term appreciate and depreciate. So appreciation, or sometimes in kind of slang, is to say the dollar is getting stronger, would look like this. If the dollar, and again, we sometimes use the word against, if the dollar appreciates against the yuan and now a dollar is worth 8 yuan, so you can think of it as a dollar buys 8 yuan. That's kind of how you could say that. In fact, it's fair to say that, right? You're buying yuan, you're purchasing the Chinese currency with dollars. So now your dollar can purchase more Chinese currency. So if everything else stays constant in the world, like all prices in native lands and domestic lands stay the same and things like that, what does this do to the price of computers and shoes? Well, now, and I've just recalculated here, the computer is going to cost 8,000 yuan in China, Remember before, the computer cost 7,100. So the price of the computer from the Chinese point of view, remember they're buying an American computer, the computer just got more expensive. And the shoes now cost $125 from the American point of view. Remember, these are Chinese-made shoes. They're made in China, and Americans can buy them for $125. Previously, they had to pay $140. So if you're an American and your dollar appreciates against another currency, then all the goods that you buy from that country are less expensive. They're more affordable. And you can imagine then we would probably want to buy more of those, right? So the one, here's the first sort of big sort of law, you might say, of currency, is that the stronger your currency, or the more your currency appreciates, the higher the value of your currency, the more goods and services you can afford to buy from outside of your borders. In other words, the more imports will take place. But that, you might say the hidden cost of that, the downside of that, the bad thing, you might say, of a strong dollar is that the Chinese aren't going to buy as much of our stuff, right? Because from the Chinese point of view, our computers don't cost 7,100 yuan anymore. They now cost 8,000 yuan. So the Chinese are going to say, boy, those computers are getting very expensive. And it has nothing to do with the actual price of computers. The computer still sells for $1,000 here in America. It's just simply that the exchange rate between yuan and dollars has changed. And therefore, the Chinese see this as more expensive. They don't buy as much of our stuff, right? So the conclusion then is that the Chinese would buy fewer US computers and Americans would buy more Chinese shoes. And if you think about that from imports and exports, from that point of view, the Chinese are buying fewer US computers. So that means Chinese net exports would increase. Remember, net exports is your exports minus your imports. And the Chinese imports would go down. Chinese are not importing as much. And therefore, the value of this little equation here, which is net exports, is going up. And from the American point of view, that should say net. American net exports is decreasing. And that's because, and I guess I should say this is going up right here for China. From the American point of view, American exports are going down and Americans are importing more. Remember that a Chinese export is an American import, and a Chinese import is an American export, right? So do we want American net exports to decrease? Well, not necessarily. I mean, I guess it really depends, right? If we're in a recession, we don't want American exports to decrease, because exports, or net exports, is part of aggregate demand. Remember, aggregate demand equals consumer spending in your country plus investment spending plus government spending plus net exports. So if we're in a situation with a recessionary gap, we want to try to increase aggregate demand, so we'd like to see net exports go up. Of course, if we're in an inflationary gap, we'd like to see the reverse. We'd like to see aggregate demand go down, and therefore maybe something that would decrease net exports would be good. So you can begin to start to say, well, is a strong dollar good for the economy? And the answer is, it depends. It really depends on what the economy is doing right now and what you want the economy to do. A strong dollar, an appreciating dollar, is going to lead to a fall in net exports. And therefore, it's going to lead to a fall in aggregate demand, which might be the perfect medicine for an economy if the economy is overheating and seeing rising inflation. Whereas a weak dollar, the opposite of strong, obviously, a weak dollar or a depreciating dollar is going to do exactly the reverse. So we actually want to see, during a recession, we'd like to see the US dollar depreciate against foreign currencies, as that will then allow, or you might say sort of incentivize foreigners to buy our stuff. So any industry here in America that makes money by exporting goods to the rest of the world likes to see the US dollar be very weak, right? But as a consumer, you and me, if we're, personally, I don't really directly benefit from exports. I'm a teacher. I don't work for a company that exports things. So I don't have a personal vested interest in exports occurring. I just like things that are inexpensive. And so I like a strong dollar, because a strong dollar means I get to buy a bunch of foreign made goods at a reasonable price. So it sounds good to me. Also means that if I want to travel overseas, it means my vacation is going to be cheaper. My dollar can purchase more foreign currency, and I can enjoy my vacation a little bit more. So there's absolutely no way that you can, with confidence, say that appreciation or a stronger dollar is necessarily good or necessarily bad. It really depends on which person or group you're talking about in the economy and what the current state of the economy is. So does anyone have any questions at this point? I've got a couple more things we can talk about, but anything on that you're curious about? All right, well, the next thing then is to answer the question, what is it that causes the currency value to change? And so for that, we want to kind of think about this in terms of a market. So the value of a currency, remember I said a few minutes ago that when you exchange dollars for Chinese yuan or anything, Canadian dollars, Mexican pesos, euros, you name it, Japanese yen, when you exchange the dollar for a foreign currency, you can really think of it as you are purchasing the foreign currency with your dollars. That is what you're doing. You're purchasing foreign currency. And if you're purchasing something, then there's a market there because there's demand and there's supply. Something is for sale and something is being purchased. And so we have what we call the foreign exchange market. And the foreign exchange market is oftentimes abbreviated as Forex. That is the foreign exchange. You'll see that. And if you've traveled internationally, when you're near the airport or the train station or at the border or whatever, you will see signs that say Forex, and that just stands for the foreign exchange. So you can exchange your currency. All right. So the way we think about currency exchange, and this is all going to be, this is what's called bilateral currency exchange. So we're talking about dollars for yuan. Bilateral meaning two. It's just two entities here. Of course, in the real world, there are hundreds of different currencies. And so we would want to think about dollars compared to many different currencies. But you can simplify it and simply say, okay, dollars versus yuan, let's just pretend there's a little world where these are the only two currencies. And then the lessons we learn from this, we can definitely apply to any exchange between two countries. So I've drawn this up here with this market here on the left, this diagram here on the left. You can see it says at the bottom, quantity of US dollars in the Forex market. So this is the market right here for US dollars in the foreign exchange market. So be clear about that because it's very confusing. We have already learned about a loanable funds market. That's not this. We've already learned about a money market. That also is not this. This is a different market altogether. So briefly, the supply curve here. Supply means you're offering something for sale. The thing that's being offered for sale here is US dollars. These are people that have, so supply represents everybody who has US dollars and is currently looking to exchange them for Chinese yuan. So anyone with the US dollar who currently wants to not have the US dollar and instead would rather have the Chinese currency is represented by the supply of US dollars. So you probably have dollars, I have dollars. Neither of us probably is currently trying to exchange them for Chinese yuan. So neither of us are represented by this supply curve. There's only people that are actively trying to exchange their dollars. The demand curve. The demand curve in this model represents everybody who wants to purchase US dollars with Chinese yuan. So the demand curve here represents everybody in the world who currently has Chinese yuan who would like to trade them for US dollars, or you could say would like to use those yuan to purchase US dollars. So we have supply and demand, we have market forces, and there is a price, an exchange rate as it's called, that emerges here, right? And so I've drawn it in here. It says 7.1 yuan, that's the symbol for yuan, per dollar. That's the price of a dollar. The price of a dollar in this market is 7.1 yuan. And you can see on the top left at the price axis, it says price of US dollars in foreign exchange market, yuan per dollar. So you price dollars in yuan, right? Just like you would price computers in dollars. So the price of a dollar is the yuan. Okay. Let me see. Yeah, Gabby, I'll be putting this on Schoology when I'm done. It'll be on YouTube, and I'll make it. I think whatever. I'll send it out to you guys somehow. So either Schoology or email or both. Okay, so that's the market for the US dollar. Now over here is the market for the yuan, and it's important that we have them both because maybe you already sort of realized this. If the supply of US dollars represents everybody with dollars who currently wants yuan, then that supply curve is also, in a way, this demand curve over here. Because if you have dollars and want yuan, then you want yuan and you are willing to buy them with dollars. Yeah. So if supply here shifts, then demand here shifts. And the same would be true of this demand and supply relationship. So in the market on the right, this is the market for yuan. And so the supply curve, these are all people that have yuan currently and are looking to sell their yuan for dollars. And the demand curve is everybody who wants yuan and is willing to buy the yuan with dollars. Okay, and so we get a price there as well. And notice this price, 14 cents per yuan. That is approximately, rounding error here, that's approximately the reciprocal of this market price. And they have to be that way, obviously, right? Because if you're trading a dollar for 7 yuan, then you're effectively trading 14 cents for 1 yuan. All right, any questions on just the look of the diagrams and how they produce an equilibrium? One thing I would do in class, and some of you probably can figure this out, is, we can hypothetically say, well, what if just hypothetically, what if the market price, or what if we just, I don't know, what if the US government was like, we're not going to let dollars be 7.1 yuan, we're going to make dollars 5 yuan. That's going to be the new price of dollars. Well, that price is down here, and we would then have a shortage of US dollars, right? There'd be a tremendous increase in quantity demanded. A lot of Chinese people are like, yeah, let's get those cheap dollars. And a lot of Americans are like, I'm not going to trade the dollars for only 5 yuan. So you'd have this shortage. And the same would be up here. So market forces bring the market price into equilibrium, just as they would in any other market that we've ever studied before. But some countries, and this kind of foreshadows the notion of so-called currency manipulation, some countries do set the exchange rate for their currency, and they say we're going to make it 5 yuan, per dollar. That's just the way it's going to be. And then you have a market disequilibrium. You have a problem. You have a shortage or a surplus, and there are ways that the government can try to accommodate that. But that kind of it's a topic in AP Econ. It's just I usually get into that in more depth down the road. Okay, so this is how we set the market price. This is how the market price is set. And a moment ago, we talked about the appreciation or the depreciation of currencies. So if prices are going to go up or down, or sometimes we call these exchange rates, if the exchange rate or the price of a currency on the Forex market goes up or down, it's due to a change in the demand and or the supply of that currency, right? Market forces. So over here, I have a list of the shifters of supply and demand when it comes to this stuff. So what shifts the supply and demand of a currency in the Forex market? And I have a little asterisk here. First, if the supply of one currency increases, then the demand for the other currency must increase too. So I talked about that. I hope that makes some sense to you. You cannot supply your currency for another currency without demanding the other currency. So the two are kind of linked. So I've drawn this up. This list here is designed so that we're looking at it from the American point of view, and that everything I've put down here is going to increase the supply of dollars and it's going to increase the demand for yuan. So you can think of it as this way. Every point, these 4 points down here, 1, 2, 3, 4, these 4 points, all of them would make people want to exchange their dollars for yuan. They would increase the likelihood that you'd want to trade your dollars for yuan. So let's look at these 4. I use the word relative a lot, and that is because what matters here is a comparison between things in the two countries, okay? So when we say relative changes, I mean, how many of you, and chime in real quick with a yes or no if this makes sense to you. How many of you have sat in a car, hopefully you're the passenger when this happens, you're sitting in a car, you're looking out the side window, and there's a car next to you, or sometimes it has to be a bigger vehicle like a bus or something next to you, and all of a sudden you get the feeling that your car is moving backwards. And then it's a very unsettling feeling, and then you very quickly you realize, wait, my car's not even moving, it's the bus that's going forward, right? And so now your car, in absolute terms, your car is not moving, that's correct, but relative to the bus, your car is in fact going backwards. Like relative to the bus, your car is going backwards. So relative simply means in comparison to. So increase in relative real income in the USA. So that means that real income in America has gone up in comparison to China. We are essentially getting richer faster than China. This is going to lead Americans to purchase more goods altogether. It doesn't really matter where we purchase the goods from. The bottom line is we assume that as incomes go up, as real income goes up, American consumption goes up, and we start just consuming stuff. We buy things made in America, we buy things made in Germany, we buy things made in China. So really, if there's an increase in American real income relative to China, then we start buying more from China. We start wanting to buy more from China. And the reason why we have to do this in relative terms is because imagine a world where America's real income is going up, and China's real income is going up, and they're both going up at exactly the same rate. So both countries are getting richer at exactly the same pace. Well, both countries are going to buy more goods. They're both going to buy more goods from each other, and then the net effect in terms of currency is nothing. It kind of offsets each other. And so it wouldn't actually change the exchange rate. But if American incomes are going up faster than Chinese incomes, then we're buying more from them. But how shall I say this? We're buying more additionally from them than they're buying more additionally from us, if that makes any sense. So that means we need to get more Chinese yuan. So that's going to increase the demand for the yuan. The next one is if there is a change in the price level between the two countries. Again, relative price level. So in other words, if things here in America become more expensive compared to what's happening to things in China. So I'm not talking like earlier when we compared the price of computers and shoes using the exchange rate. I'm saying that if let's go up here again. We had computers that in the US were selling for $1,000. Let's just say hypothetically that there are computers that are selling in China, Chinese-made computers that are selling for 7,100 yuan, and there's American computers here in America that are selling for $1,000. And let's say over the next 5 years, we start to notice that the price here in America of computers is going up. It's $1,100, $1,200, $1,300. But those Chinese computers over in China are still priced at 7,100 yuan. It's going to start to make Americans go, gosh, those computers that seems like a good deal. I want to buy those Chinese computers now. And in order to buy those Chinese computers, you got to get the Chinese yuan. You have to actually purchase the Chinese currency. So that's going to increase the demand for the yuan. It's going to increase the supply of the dollar in the Forex market. The third thing would be an increase in the relative real interest rate in China. So this is a kind of a big topic that I usually have to pause in class and kind of illustrate in greater detail. But when people save their money, so remember the household sector, you consume some of your income, you save some of your income. When you save your income, what you're looking for typically is a return on your savings. You would like to earn some sort of a gain on your savings. Typically, we would measure that in interest rates. As we've said before, the higher the real interest rate in the loanable funds market, the more people want to save money into that loanable funds market because it means there's a greater reward for saving. Well, in this little bullet point right here, we introduce the notion that you don't have to save your money in your own country's financial markets. You can save your money into a foreign country's financial market. So how do you do that? If you're a saver, and I hate using that, I mean, that's the right term in econ. It's just not the term anybody in the real world uses. In the real world, we would say you're investing your money, right? But here in econ world, investment means purchasing capital. So I'm going to suspend the econ rules and I'm going to speak like a bit more of a normal person. If you've got some money and you want to invest it, one thing you could buy is you can buy bonds here in America, US bonds. And US Treasury bonds, US Treasury bills don't pay very much interest. They pay a very low rate of interest, right? The Fed cut the interest rate really low. Treasury bills are paying nearly nothing. Maybe you're not satisfied with that kind of return on your savings. You don't want to get nothing for your, on your money. Maybe you do. Maybe you're okay with it because it's very, very safe, right? The American government, we've never defaulted on our bonds. Well, you'll definitely get your money back, but maybe you want something more. So you go and you start looking at China and you go, what are Chinese bonds paying? And you notice maybe, I'm just making this up, their bonds are paying 5%. Like, oh, well, 5% is better than 0%. I'm going to start purchasing Chinese bonds. But in order to purchase Chinese bonds, you can't purchase them with dollars. You have to purchase them with yuan. So before you can purchase the Chinese bond, you have to first exchange your dollars for yuan. And then from there, you can go ahead and purchase the Chinese bond. So there are so many variables that would affect someone's decision about how to invest their money and where to invest their money, whether it be here in the US or in China or somewhere else, that this one's very difficult to fully understand and to fully buy into, because what is not true is that everybody is now, because people are not suddenly running out and buying Chinese government bonds simply because the interest rate's higher than it is here in America. There are other reasons why people are purchasing American bonds at a low interest rate, namely the safety, the reliability, the trustworthiness that comes with buying American bonds. To say nothing of the fact that if you buy a Chinese bond, and you, of course, again, have to take your dollars, first exchange them for yuan, go buy the bond. Maybe you hold the bond for a while, you earn interest. What currency do you think that interest is paid in? It's paid in yuan. And then in order to make that money usable for you, you have to convert it back to dollars. Well, you sure hope that between now and the time that you convert it back to dollars, the exchange rate hasn't changed in a way that's going to harm you. So you're taking on quite a bit of risk by trading your dollars to another currency, because now you don't have to just pay attention to what the value of Chinese bonds is going to do over time. You also have to be mindful of what the exchange rate between the two countries is going to do over time. And when you're throwing in multiple variables, it becomes very, very risky. So it's not likely that the average investor, saver, you and me, is going to go out and start investing in foreign countries' bonds. But large institutions, you might say professional investors, they certainly do that. But the big takeaway that we can say is that other things constant, right? Ceteris paribus, all other things staying equal. If there is an increase in the relative real interest rate in China, if Chinese interest rates go up in comparison to American interest rates, so in other words, if our interest rates go down and China's stay the same, but if the difference between Chinese and American interest rates grows larger and Chinese interest rates are higher than American, then we would expect to see some increase in flow of savings from America to China. And that is actually called capital outflow from the American point of view, and from China, it's called capital inflow. But in order for that capital to actually get there and to be usable, it has to be exchanged. And so it flows through the foreign exchange market. So every time the Federal Reserve Bank of the United States cuts our interest rates, we can assume that that's going to have a bit of an outflow of savings effect, that some of the savings in our loanable funds market is going to flee the country and go somewhere else looking for a higher rate of return. But again, remember, this is all pinned on the idea of other things constant. And in the real world, variables are changing all the time. I mean, the Fed cuts interest rates not just on a whim; they cut them because other variables are happening that they don't like, and they're trying to react to that. So, you know, if you looked at real data and you said, "Boy, Arno, every time the Fed cuts interest rates, we actually see more people buying American bonds." So what you taught us is wrong. I would say, well, they're buying the bonds because they're very nervous about being invested in stocks, or they're nervous about their more risky investments. They're buying bonds because bonds are safe. And the fact that the Fed is cutting interest rates, they're cutting interest rates because the world has become more risky, and the economy is hurting. And so there's two things happening at the same time. But if the Fed hadn't cut interest rates, but the world became more unsafe, you'd see more people buying US bonds. So there's a lot of moving parts. The last thing is really simple, and that's just a change in the taste and preference for Chinese-made goods. If for some reason Americans started to want to buy more Chinese-made goods, Chinese cars or Chinese computers, then you would of course see more demand for the Chinese yuan. So with that in mind, again, with all of these on the right, this whole list here, all of them increase the supply of dollars and increase the demand for yuan. So I can go ahead then and we can make a prediction. If any of these four things happens, then the supply of US dollars in the foreign exchange market is going to shift to the right. And that's going to lower the exchange rate. It's going to weaken the dollar. So I'll just say hypothetically it becomes 5 yuan to the dollar. And then over here, if the supply of US dollars increased, that means the demand for Chinese yuan has to increase, right? So then this goes, that does something like that, and this would then rise to 20 cents per yuan, right? Because 20 cents is would be the reciprocal of the $5. Okay, so we'd get some movement like that. So under any of these four things, boom, 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 all of them will lead to what? We call this depreciation. This would cause the US dollar to depreciate compared to the yuan, and the yuan would be appreciating. So that would appreciate. And then that takes us back to what we started out with. What happens when there is appreciation and depreciation? I had started off with appreciation right here. Now we've got depreciation. So depreciation is the opposite of everything written here. So aggregate demand in the US would rise. It would rise if there was depreciation. So this is kind of cool. This is where you're going to go, oh, this one in particular, I think this is one of the best ones out there. If there's an increase in the relative real interest rate in China, and I said it before, what would the Federal Reserve have to do to make this true right here? What would the Fed, let's talk about open market operations. What would the Fed be doing open market operations to make that true? They would, of course, be buying bonds. They'd be buying US bonds. They'd be increasing the American money supply, thus lowering the US interest rate, which then would actually cause the Chinese interest rate to go up compared to the US interest rate, right? It's not actually making the Chinese interest rate go up. It's just in comparison, right? Ours is now lower. So again, the Fed is buying bonds. That's expansionary monetary policy. They are making the money supply bigger. They're lowering the interest rate here in America. That is going to cause people to not want to own US bonds as much. They're going to want to buy Chinese bonds. That's going to cause the supply of our currency to increase in the foreign exchange market. The demand for the yuan is going to increase in the foreign exchange market. And that American currency depreciation, dun, 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 it causes aggregate demand in the US to rise. Well, lo and behold, what would the Fed like aggregate demand in the US to do when they're buying bonds? They would like it to rise. So this is an effect that you get through the foreign exchange markets that would be very helpful, right? So it's reinforcing. It's exactly what the Fed wants to have happen in the economy. So pretty cool. So that's kind of my prepared part. There's one other component here that I plan to discuss with you in a moment, and that is how does a country like China so-called manipulate their currency? And I'll discuss that here in a moment, but I wanted to pause real quick and give any of the five of you a chance to ask any questions that you might have, curiosities, how does this work, why does this happen, or just repeat something. Oh, it's getting pretty small. I said five of you, but really Annie's there, so that's six. Who was your other friend there, Aaron? She has me muted. She's not even listening to me. She's like, wait, is he talking to me? I think he's talking to me. Yeah, she's getting kind of suspicious now. Yeah, I'm talking to Aaron. I was asking you the other friend that you had there. I didn't know. I don't think I knew who she was.
Oh, it's Megan.
Oh, Megan. There she is. Okay, Megan.
Holly.
Got it. Okay.
Yearbook staff.
Yep, I hear you. All right.
We haven't been listening.
It's going to be recorded, and you know that, and I'm sure you're going to watch it later. So
exactly.
Yeah. I'm not hurt at all. Anybody have any questions on this stuff? All right. Well, the last thing I'll discuss then is how does a country, so-called manipulate? That's not the official word. We don't say they manipulate. We actually say they peg or they fix their currency. So let's use China as an example because they have done this in the past. They don't do it that much anymore. I mean, they do it. I guess that's not true. Here's what the Chinese do. Let me show you this chart. So you can barely see it, and I guess I wish I had it prepared for you. But if you look at the very early, like back in 2015, notice how it's like right. So right here, it's there's like a little bit there where it's flat. It's like perfectly horizontal, like right there, and then you get these. Then you get this like very sharp increase, and then it's actually horizontal again for another month or so. When you look at any data that is like any price data that is supposedly market driven, you really shouldn't have a lot of linear parts. There ought to be, it ought to look like a EKG. It ought to be a lot of that, because markets are like, I think of them as supply and demand are always vibrating in a way, and so you're always just getting sort of changes in the value. But the Chinese do they do sort of lean, and you'll see what I mean in a second here. They sort of lean on the market a little bit for the Chinese yuan to the dollar. They do want to sort of prevent the yuan from changing value too much. So what they do is they basically they used to, and I don't have the chart that going back, but prior to about 2014, they really did fix the value of their currency. So if you go back to like 2014, I mean, it looks like this, and then it'll be like this. Like anytime you see a chart of prices that looks like that, you know that it's totally controlled by some agency or some committee. And then around 2014, they sort of relaxed their control of their currency value, and you started to get more of what looks like a natural sort of price fluctuations. But what they do now is the Chinese government basically creates a range that they're willing to let the yuan float. The word is float, to float in. And I don't know what the range is. I don't know how the higher this line goes, the stronger the dollar is getting, and therefore the weaker the yuan is getting. I don't know how weak they're going to let the yuan get, but they have some control. They do monitor it. So let me just show you why, or first how, and then we can talk about why. Well, the why you can kind of figure out. I mean, the value of your currency affects imports and exports. I mean, that's the bottom line. And you know, if you want aggregate demand in China to rise, then you would want the dollar to get stronger and the yuan to get weaker. Like you would artificially weaken the yuan so that aggregate demand in China would increase. And why would they want that? Well, if you're a Chinese government with a single party, essentially kind of an authoritarian rule, you don't really want high unemployment. That's not going to be good for your party control. And the Chinese economy is very heavily based on exporting goods. So a huge amount of their employment is in industries that export goods to the rest of the world. So if their currency, if the Chinese currency gets too strong, then foreigners start to see Chinese goods as being too expensive. And that means demand for Chinese goods is going to start to fall, unemployment in China is going to start to rise, and you could have the seeds of a revolution in China. So they have a very vested interest in keeping their currency somewhat weakened. All right, so the bottom line is I don't care how authoritarian your rule are, even North Korea has a currency with upward sloping supply and downward sloping demand. That doesn't necessarily mean that they're going to allow the price of their currency to be at the equilibrium. So this is going to be the quantity of yuan, and we always price a currency in another currency. So the price of yuan is dollars per 1 yuan. That's the price. Okay, so let's say that the Chinese do want to keep the value of the yuan artificially low, right? So we all know that the price, if it's allowed to float, the price is going to be here at the equilibrium, but they're not going to allow it. So the Chinese basically put in place what you and I would know to be a price ceiling. They say we're gonna set the value of the currency at this price. So let's just arbitrarily, well, yeah, let's just say that the market would have this at, say, just for ease of numbers, say 50 cents per yuan. I'm not going to use like real numbers, but let's say the Chinese government sets it at 30 cents. Okay, so the Chinese government wants the value of the yuan to be weak, right? For reasons we talked about before, stimulate exports. So how do they do that? Well, if they set it at 30 cents, but the market equilibrium is at 50 cents, there is a fundamental market problem. The quantity of yuan demanded on the global exchange markets is going to be out here. And the quantity of yuan supplied is going to be right here, right? So the private traders of currency are going to be out of equilibrium. There's not going to be enough private holders of Chinese yuan willing to give up their yuan for dollars at the measly rate of 30 cents per yuan. And at this low rate, many, many dollar holders are going to say, man, I would love to get some yuan at this low, low price. Okay. So we have a disequilibrium. So the Chinese government really cannot, I mean, it's very hard. This is kind of an adage in economics. The market always wins, okay? You can't really defeat the market. Now, there are things that the Chinese government could do where they could really, really, like maybe North Korea can do this to some extent, and maybe the Soviet Union back in the days of like Stalin, a little after that, maybe in the 60s and 70s did this, where you basically just literally shut down your borders. Nobody gets in, nobody gets out. You don't allow there to, essentially you don't allow there to be a market at all. You just sort of like quash the market. Now there still is a market. My dad went to the Soviet Union in 1981, and he bought things with dollars in a so-called black market while he was over there. It's a relatively small part of the economy, but there's always going to be sort of a black market when you prohibit things from happening. But China is a more open economy. It's a more open society than the Soviet Union was, or North Korea is. So there are, many American businesses and currency traders who would like to purchase yuan, and there are many Chinese traders and business people who would like to sell that yuan. All right, so how do they do this? So you have a fundamental problem. You have more demand than you have supply. So the government literally is going to step in. The Chinese government is going to step into this market because this here is a shortage, right? So what would happen? The Chinese government would effectively fill up this shortage. They would say, we, the Chinese government, are going to sell or supply this quantity between QS and QD of yuan at this artificially low price. We're going to satisfy all of these buyers of yuan out here with government sold yuan. It's going to effectively, what they're basically doing is the Chinese government is causing the supply of yuan to shift to the right, but it's all comprised of the Chinese central bank called the People's Bank of China is the one that's actually doing this. So they essentially have I guess they just probably print them up. They or electronically create them. They just are willing to go out and sell yuan. And what are they selling yuan for? Dollars, right? So they're basically buying up dollars. They're buying up a lot of dollars and they're selling yuan. And that should start to kind of speak to you if you know anything about the world. If you hear stories about the Chinese have a huge amount of US dollars, they've been stockpiling dollars. It's true, they have. They've been stockpiling dollars. Now, what do the Chinese government do with all these dollars that they're buying up? They don't just keep them in a vault somewhere. They turn around and they purchase US bonds with these. They purchase US bonds. Now the Chinese government has all these dollars. What do you do with it? You buy American bonds. So when the American government is borrowing money, as it does, it borrows money by selling bonds. And one of the largest buyers of bonds is the Chinese government. And the Chinese government is buying those bonds because they have so many dollars and they don't know what else to do with the dollars. And they have those dollars because they're keeping their currency artificially low. And so they're basically buying dollars and then turning and investing those dollars in US bonds. So when the president back in 2015, or at that time he was a candidate, said, China is a currency manipulator, they need to stop doing this. What he wanted the Chinese government to do is to allow the price or the exchange rate of the yuan to rise up here. He wanted the government to stop buying all these dollars. This would cause the currency of China to appreciate. It would cause the currency of America to depreciate. It would therefore then allow Chinese consumers to better afford American products. So we would begin to see our exports increase to China as Chinese consumers would buy things. We would notice from our point of view as consumers here in America that Chinese goods are becoming more expensive and we'd buy less of them. And we would probably therefore have to turn to American-made goods or goods made in some other country. But then the other hidden side effect here that almost nobody recognizes unless you really know your economics is if China stops doing this with their currency, then the Chinese government will no longer have this huge amount of dollars with which they can buy American bonds. And now when the United States government runs a big deficit and needs to borrow money to fund that deficit, they're going to have a harder time doing it. So interest rates here in America would start to rise. So everything's interconnected. And if you want to have one sort of outcome, as Trump, I think, did, he was really trying to play towards the export industry here in America. There were a lot of other people who were saying, whoa, don't cause China to all of a sudden, cause their currency to appreciate too much, too fast, because it's going to disrupt things from American consumers' point of view, and it's going to make borrowing very, very difficult here in America. Interest rates would start to rise. So that is how the Chinese government keeps their currency artificially low. They simply buy the foreign currency to sort of soak up. Well, not really soaking up there. I guess they are soaking up. There's all this excess dollars that people want to sell for Chinese yuan. So aren't you glad that you didn't have to learn that and then be tested on that on the AP exam? Because that was unit number 6 in a nutshell, or the 80% of unit number 6. but moderately interesting, I think. And if you have any inclination in international business or international economics, I mean, there's obviously, you would review this and deal with this, but you can see how big of an impact it has on the way the world works. And it's one of those, again, it's one of these areas, I think macroeconomics is filled with this. I think you guys all got the sense. There's so much in macroeconomics I find that is unclear to the sort of median person. They don't, most people just don't know macro, right? It's a opaque science, I guess you could say. And but yet it's so important in terms of policy and politics. And so when I hear politicians talking, and I'm like, number one, do they even know what they're talking about? But number two, certainly I have a lot of doubt that most of their voters know what they're talking about. So you guys do. And so I'm more confident in you going forward, making somewhat better decisions, or at least knowing that the world's confusing and it's complicated, and maybe the best answer is I'm not sure. I think I'm not sure is a really good answer to a lot of questions. So that is all I really wanted to share with you guys. I hope that was, I don't know, enjoyable, insightful. Anything from the peanut gallery? All good? All right. All right, guys. Well, I'm going to bail. I'm going to go have some sandwich for lunch, and I think I can still mow my lawn before the rain comes. So that is my goal for the afternoon.
Bye.
Bye, Erin. Bye, Annie. And bye, Megan, right?
Yeah.
Great. Awesome. All right. Thanks for joining me. And Joe, it's been awesome. It's been awesome working with you this year. I've loved you as a student, and
You as well.
I'm looking forward to hearing good things from you as you go on into the healthcare world.
I will keep you updated.
Cool.
That's for sure.
Awesome. All right. You take
Enjoy
care
your
of yourself.
sandwich.
Thanks very much.
Bye.
Jimmy K, keep running.
Yep.
Where are you going to school, Jimmy?
Temple.
That's right. You told me that the other day.
Yeah.
That was like kind of exciting. So enjoy track. Are you doing track or cross country or both? Is that like
Both.
okay. Is that normal in college? I didn't even
Yeah, it is.
Okay. Cool. Well, good luck to you. I'm
Mhm.
looking forward to hearing good things. Stay healthy.
Yes.
And keep in touch. And Novi, what's your plan again next year? Remind me one more time. There we go.
Minnesota Twin Cities.
That's right. Okay, cool. That's exciting. That's exciting. Do you wish you were up there right now? You could be part of all the action.
Yeah, kind of.
Yeah. Yeah, for sure. Well, go change the world. I'm pretty sure you will.
My mom would be really worried about me, though.
Yeah, that's what parents do. But you just say, I'm good, Mom. You raised me well. I'll be safe. All right. Well, you take care of yourself, and reach out if you guys have any questions.
Okay,
Sounds
bye.
good.
All right. Take care.
Bye.
Bye-bye, guys.